Okay, so that's the word that's coming in for the pharmaceutical space as well. This, of course, down over 8% on Monday. Let's watch out very closely for how it reacts come opening bell. Hemang Jani also now here with us on the show. Good morning. Hemang Jani, where should we begin? The levels of the indices, and maybe in how much time we'll see the Bank Nifty hit an all-time high?
Yeah, good morning, Nayantara. I think the overall sentiment and particularly buoyancy in our market is pretty much visible, and as we move ahead in the earnings season, people are getting a little more confident about the earnings trajectory for next couple of quarters, and we have also upgraded the FY23 earnings marginally. So there is a sense that both in terms of earnings and flows, our markets are extremely well positioned, and that gives us a lot of confidence that one does not too much in terms of the global markets or other factors which are there, and use any small dips that you see in the market as a buying opportunity, as the overall outlook continues to remain quite positive.
All right, stay on with us. Let's also hear out some more top fundamental stock ideas there. Neeraj Diwan of Quantum Securities, he says Vedanta is a good bet based on the valuations and the business. Let's listen in.
The business that is there, whether it's aluminium, copper, so I think those businesses have huge potential, and going ahead also I feel that valuation wise the stock is still not expensive. And valuation-wise, you saw, that potential that is there, whether it's copper, whether it's aluminum, it's huge. So even, zinc has a huge potential going ahead. So purely on that, I would say that one needs to be invested in something like Vedanta. Though what the management does next is someone, which anyone's guess. And they have been disappointments earlier from the management. So I think they must have learned their lessons from what happened 2 years back, and now I think for at least in the near future, there should not be something like that which is going to be negative for the minority shareholders. So I think purely on valuation, I still feel, and the business, I still feel Vedanta is a good bet to stay invested in.
Okay, that's a stock idea coming in from Neeraj Diwan. Hemang, hi, good morning. Good to have you on the show once again. Hemang, just wondering the kind of commentary that we've seen from some of these new age tech companies, right, which is just starkly different from what we heard at the same time last year. I mean, I'm just looking at Paytm, for instance, and they're saying there's another quarter of narrowing EBITDA losses, which have now actually improved 40% on a sequential basis, and they continue to guide to turn profitable by September 23. Just wanted to understand the likes of Nykaa, Paytm, PB Fintech, anywhere where you're still recommending a buy after the mammoth fall that these stocks have seen.
So what has happened, Aisha, is that the stocks have corrected quite sharply, and the entire narrative around the fintech companies and the valuations that they were getting, now there is a 360-degree change both in US and even for our markets. And we have also seen how the liquidity position has actually changed in terms of the rates going up. So people are looking out for the companies with a better cash flow or profit visibility, and in that template, some of these fintech companies are not fitting in. So having seen a cut of let's say 50 to 70%, some people might get a little tempted to look at them afresh, and some of the companies are delivering relatively better numbers, particularly Paytm. I think last 2 quarters there is some improvement in the incremental data points that we are seeing, and same is the case with Nykaa. But our take is that we are far away from a point where there is going to be a conviction about the profitability. So while they may provide a 10-15% kind of a pop basis the data point, since their valuations are still extremely stretched and no sight of the profitability, we would not be comfortable, giving out a buy reco. But as I said, maybe a small pop here and there is possible.
Okay. Well, we've seen comeback and a real stunning comeback in some of the railway stocks, whether it is RETS, private names like Tasmaco, Railtel, RBNL. Post, after defense, is railways now the next one to move higher? If yes, why?
So Nikunj, yes, as a part of the entire, PSU theme, whether it's PSU banks or some of the, other PSUs, whether either there is a divestment story or the business turnaround, like what we've seen in case of Coal India and some of the commodity plays, people are looking at the PSUs with a fresh perspective, and railways being a big capex, story. Some of these companies which are the beneficiary of a higher capex could get benefited. So we haven't really looked at any specific names, so I would not be able to put out any reco there.
And in the railway space, these stocks are going higher on strong volumes, at least the two-digit railway stocks like RVNL and others. Yeah, I think these stocks have done reasonably well. There's volume chasing these stocks. That's the more intriguing part. It's not that they're rising up on shallow volumes or volumes which are just about at average or slightly above par. But then I think in terms of momentum, the couple of stocks which I would be focusing on specifically, I think something like Titagarh Wagon, I think that stock looks extremely attractive on the charts, purely on the fact that the stock is heading towards a big breakout of a multi-year resistance. I think 179 or 189 approximately is the major high for the stock on the longer term basis, and it's coming very close towards a breakout of this major resistance for itself. The other stocks, they have a very smaller degree of history, just about maybe a 2-year, 3-year history for themselves. So it's very difficult to try and forecast it from a long-term play. But I would probably focus on something like Titagarh Wagon, from that space. Maybe a Texmaco Rail as well looks attractive about the 55 plus mark. IRCTC, of course, the stock has shown some recovery, but then it's nothing. Compared to what the stock had seen from the 2020 low. So I think it's still a long distance away from even coming back towards its life high levels.
Hemang, there's a lot of buzz right now in the hospital space, right? We saw the big KKR Max Healthcare deal with KKR exiting. You got an IPO listing next week of Global Health, which will be of Medanta. There's all this buzz about Manipal Healthcare. And today in the Economic Times, you're reading about how IHH is in conversation with SEBI when it comes to the open offer for Fortis. How is the hospital pack looking for you, Hemang, and what would be your pecking order?
So hospital space is looking extremely good, and if you see the last whole year, this was one space where we had seen phenomenal growth in terms of revenue and profitability both, and some of these companies also have built some interesting subsidiaries, be it on diagnostic side or on the side of the distribution of medicines and the entire chain around it, like what Apollo Hospitals has built. So I think even on a higher base, there is a sense that one is getting in terms of the incremental growth that they can deliver over the next 2 years. And our sense is that 18-20% growth over there is very much possible for the kind of additional capex that some of these companies have undertaken. So we do see a good momentum for the space. Apollo remains our top pick. But apart from Apollo, I think Max Healthcare could be another company where there can be a good, interesting opportunity for investors for a 15 to 20% kind of an uptick.
Hemang, what's the outlook when it comes to a Cummins India? After having achieved the highest quarterly revenue and profit across their geographies, we've seen the export growth as well has been strong, but the management has refrained from giving any sort of a guidance due to the challenging environment. What do you think this indicates for the future quarters for Cummins?
So our take is that the capex as a theme is in the vogue, and there is definitely a liking for some of the companies where the overall performance is good, where the management is guiding for a better growth ahead. So from that perspective, we think that Cummins could be one stock to look at, though company has refrained from giving any strong guidance. But we do think that people would like to get into something like this. And apart from Cummins, we also think that companies like ABB, Siemens, Larsen, I think at the investor level, the participation is not enough, and these companies have just started a big up move, and the cycle is turning around. So we see a lot of scope for the capex theme to play out.
I wanted to get in your thoughts as well on a Piramal Pharma. Yes, we've seen the company deliver those losses in the quarter gone by at about 37 crores, but margins have expanded this time around. Have you tracked the internals, and what's the outlook?
Yeah, so I think post demerger, there was initially some sort of a derating or a sell-off in the stock, but this is something where we think that there is a case for a multiple triggers, be it in terms of much better revenue profile with margin expansion, and the fact that compared to some of the listed CDMO plays both globally and India, this is still quoting at about 12 to 15% kind of a discount. So we don't have a buy rating on this one, but we do like this space, and that can provide some short-term opportunities for traders.
Is going to be in focus is also going to be Maruti, and just picking it up from the Economic Times this morning, Suzuki Motor actually has raised their FY23 sales forecast for their India business, and they've raised it by a good 3.04 million units. Earlier, remember, it was about 2.91 million units. They're saying that sales in India are expected to grow by 21% in FY23, and that they are expecting a very, very strong recovery. This enthusiasm or confidence, of course, has come in on the back of the bumper sales that we've had from Maruti of late. Kunal, you also believe, right, that one can extend their list from within autos to beyond M&M and Tata Motors to a Maruti?
Well, yes, I think it's time to do that, because I think Maruti, after a lot of time, has managed to show signs of strength. So, we look out for relative strength, not just the strength in terms of prices, but strength with compared to most of the other peers. Now, there was a phase where M&M did exceptionally well from the auto pack, led by TVS Motors. I think both these stocks had done reasonably well from their May-June lows for themselves. But then there came a phase where M&M started to go sideways, and the other stocks started to move up higher. In that regards, Maruti started to outperform quite strongly. The stock managing to consistently break above its resistance with strong degree of volume. So 8,300, 400 was the first major resistance. Then came 8,800, and then the 9,000 psychological mark for Maruti. And the stock has been trading above those levels with a fair degree of strength as well. So when we look at the charts, particularly the relative strength factor with respect to most of the other peers and the performing peers like M&M, there is a lot of credibility which we can ascertain towards the charts. And I would believe that Maruti should be heading towards the life high levels of 10,000 plus. 10,000, 10,200 is where I would place the targets for the stock over the near to medium term.
And we can't go forward till the time we don't go back, which is what we'll have to do and talk about banks. It's not going to be Maruti. We'll have to revisit BOB. We'll have to revisit State Bank of India. I just want to put a graphic up here. It's a graphic which is very simple. The ownership patterns. And with all the halabaloo, all the hum and drum, all the excitement that PSU banks are back, they are the ones where the buck has moved. The ownership patterns in some of the PSU banks has not dramatically changed. Foreign institutional investors for the longest time, they've not bought into PSU banks. Domestic institutional investors, they own PSU banks, but the incremental uptick is nowhere close to the kind of price appreciation what we've done. So that data point will just come up on your point here. That's the commentary, and what is the tone of the commentary from some of the PSU banks. Now that's the talking point here. We all know that PSU banks have big clean balance sheets, corporate NPAs are under control, retail lending has started, and they have a lot of CASA. But what matters is also positioning. Why has HDFC Bank not participated in this mega rally? Well, that's because of ownership, merger concerns. ICICI Bank 3-4 years after the Chanda Kochar issue, it consolidated, it lost its prime positioning, and when the cycle recovered, it really made a comeback. Let's look at the graphic, please, if it's there. Hemang, do you see for some of the PSU banks there is still a long way to go, because this is a sector where institutional interest is low. This is a sector where foreign interest is low. So now by design or by force, institutional investors will be forced to buy them.
So I think, Nikunj, what you're saying is right, that, on the one hand, you're seeing a big turnaround in their core operating parameters. And on the other hand, the valuations remains, incrementally attractive. Along with subsidiaries, it is one of the companies which is quoting at, let's say, 1.4 time price to book, where you are looking at a 32% kind of earning growth for the next 2 years. And parameters like credit growth, the overall, CASA ratio, and the NII part continues to remain good. So the sense one is getting is that if you are going to see a good capex-led revival in the economy, then some of these banks are in a much better position to participate or benefit from it because of their overall franchise and the growth profile that one is looking at, coupled with valuation. So it remains one of the top performing names for us, and both State Bank of India, DOB, and some of the smaller banks, something like a Union Bank also we think can do very well from a 1 to 2 year kind of a perspective.
Try my luck with these, Kunal, whether or not you track PI Industries on the charts, largely on the back of numbers. Sequential growth has been pretty strong. But there's also an Aptus value. Do you track that one?
Yeah, I do track both of them. PI Industries, I think, is now very close to its life highs or major highs. I think 3,500, 550 has been the major high for PI Industries. It's a very moderate beta kind of a stock. It doesn't go into sharp periods of downtrend, but whenever the downtrend starts off, it's more prolonged for the stock, and it goes into a very gradual kind of a phase, even in terms of recoveries. For example, the major lows which was formed was in the end of September when the stock was at 3,000 or sub 3,000 levels, and from there, rising 10%, the stock took a very slow and a gradual kind of a trend for itself. So it's an indication that possibly the trend is quite strong and the stock should be breaking past about the 3,500 mark. So typically when a 61.8% retracement is completed from a fall, we expect that the stock to break past about the major highs and rise up by at least another 5% to 7% higher depending on the degree of the beta of the stock price. So I think in this regards, maybe a 3,650, 680 could be a target range for PI Industries. Aptus, on the other hand, is still a stock which is consolidating. The recent charts had shown a bit of momentum, but then the stock has lacked a lot of volume participation. So compared to the previous trends when the stock had done exceptionally well, the volume participation in this leg has been a bit more average for Aptus value. So I would believe that that indicates that the stock may consolidate a bit more. A breakout about 375, 380 could be a potential big breakout for a stock like Aptus. So one has to either wait out for the volumes to increase up higher or the stock to break past about 375 plus.
Okay, but let's return back to the banking pack, and why not? Soon after opening bell, the expectation is we will see the Bank Nifty hit a new all-time high. So let's now tell you about the top banking bets of Sanjay Mukim. ICICI, HDFC Bank, as well as SBI. My colleague Pankaj Poddar now joining in to tell us more about Sanjay Mukim's latest note and what he's saying about banks in particular. Good morning, Pankaj.
Good morning. When we just look at really the latest report coming in from JP Morgan regarding India's strategy, it's an interesting one that we're talking about. So every person on the street is talking about how India valuations are particularly at a premium, especially to other emerging markets, especially to what MSCI overall emerging market index is trading at. They've done some analysis which says that India is trading at 27% higher than its long-term averages. Now, they've also done some analysis of the index within that. So they're saying that Adani group of stocks which have been added are trading at a very, very high value, and that is making India valuation look very, very skewed. Otherwise, India valuations are just about 10-12% higher than the last 5 years average. A couple of quarters of stable prices can bring the core valuation back to what normal is. So X and Adani stocks, they've done the valuation of core 40 stocks that are there in the MSCI index, and that makes them believe that India is only trading at a 10 to 12% premium, and 2-3 quarters of stable returns or absolutely flat returns will make India look much better than what it was earlier. However, they also say that consumer durable pack is looking at interesting, and more interesting is what the banking pack is looking at. Largely, there are 3 reasons for that. One is banking stocks have not performed, they have just started to perform. Second, what they are saying is that the numbers of the banking industry have particularly looked very, very strong, which makes the outlook pretty strong, and that means they believe that flows could be attracted towards this sector. Now, within these names, the likes of ICICI Bank, HDFC Bank, SBI are some of their top picks, and they continue to maintain that banking index is the best way to play India, at least in the near term.
Okay, so that's Sanjay Mukim's note with HDFC Bank, ICICI and SBI topping the charts when we talk about the banking pack. It's of course a sector we'll keep talking about. The other one that's taking a lot of the limelight right now because of deal activity as well as the primary market is the hospital space. And here's Deepan Mehta of Elixir Equities talking about the hospital packs and his top choices.
Last quarter, the June quarter was very good for the hospital companies, and their operations have now gone back to beyond COVID levels also. And healthcare is one spending which is going to keep on increasing. It's secular in nature. There's greater awareness and availability and that's going to drive the volumes at hospital companies. So one should have a slightly longer term view and look at investing in a few hospital companies is perhaps the best way to play the healthcare investment theme as well. For usual disclosure, we and our clients are interested, I think, go for the largest company. Apollo, I think the way they have strategized in the kind of capital allocation policy and the value which they are creating in their digital business, the digital offering is quite impressive. So I would go with that company. Of course, there are other players as well, but it's just that when you like a sector, you go for the market leader over there, and that generally works out pretty well.
Okay, there is another pocket which I think is worth revisiting, and that is the two numbers which have come out from the diagnostic companies. One is Metropolis and second is Dr. Lal. And both these stocks, in a sense, have seen first a re-rating, then a de-rating. Metropolis, at the peak of the COVID crisis, naturally, everybody was going to diagnostic labs to get testing, to do more follow-ups, when COVID had hit India, when COVID had hit the world, not just India, but COVID had hit world. These stocks got massively re-rated. But then came the realization that the COVID bump up is over and the stocks have come down. So for Metropolis, which was at 3,400, came down to 2,700. But the core business now seems to be making a comeback. Margins are still above 20 for Metropolis. Margins are still above 25% for Dr. Lal. So I think this is another space which I would say is worth revisiting. First the re-rating, then the de-rating, now a realization. Now I think the steady flow of cash, steady cash flow will start again as the world is adjusting to the new normal. And the new normal for diagnostic companies is growth, market share gain. Indians will get more conscious, specialized services. The focus would really be on urban India rather than rural India, where I think there would be a war in terms of because of price consciousness. But in urban India, you are going for more tests, more specialized tests, quick tests, and that I think really would be the hallmark. The only problem here is that this is a space where competition is huge. Hospitals are giving it the diagnostic services now. More and more chains are getting added now. So that in a sense becomes the biggest challenge here, if you frankly ask me, in terms of a moat. Naresh, what's your take on some of the diagnostic stocks?
So I would expect them to be more sideways now. The only case what makes out is that the bottom is in place because both these stocks have made a base wherein, say for example, if you look at Metropolis, between June to September made three bottoms around that 1400 mark. Same is the case with Dr. Lal Labs. It made a bottom around the 2000 mark. And both these names went back to the pre-COVID prices. The pre-COVID highs which were there for Dr. Lal Labs was around the 1800, 2000 mark, made a base around that. It has already bounced back a good 20-30% from that. Metropolis on the other hand looks a little more interesting because the stock has not seen a big bounce back. It is still lower than the COVID times, pre-COVID times. So overall, like Metropolis, wherein a dip to 1600, 1650 should be a buying opportunity. But I would expect it to be a slow and steady move, unlike what happened in the COVID era. Not expecting it to be a massive move. So out here, buy on dips and sell on move towards 1850 to 2000 levels for Metropolis.
The talking point today has to be the all-time high, the ring of an all-time high for the Bank Nifty. Now when we went home on Monday, it was almost there, 120, 130 points, and then the Bank Nifty is going to be making a new high. If SGX is anything to go by, if global cues are anything to go by, it looks like we are in for a new ring of an all-time high. So let's establish those data points here. All-time high is 41,840. Last trading level, which was Monday's trading level, 41,686. So we are at what, less than 200 points away from an all-time high, and hopefully we will have it today. Interestingly, when markets are at an all-time high, the YTD return for the Bank Nifty is 17%. It really has been the biggest standout mover, so to speak. And which are some of the banking stocks which have really contributed to the real surge in the Bank Nifty?
It has to be in combination of SBI and it has to be in combination of ICICI Bank. SBI and ICICI Bank are two stocks which in a sense have really done this magic. Hemang, we've discussed SBI at length. Numbers are firing full cylinders. Now it's very easy to say, okay, market's new, the stock has run up, but based on these numbers, do you think the longevity of the outperformance in SBI is not only real, it is here to stay?
Absolutely, Nikunj. In fact, over the last 2 years, if you see the kind of turnaround that SBI has posted, it's mind-blowing. So on the one hand, the operating parameters have improved and the contribution which is coming from subsidiaries, and if you adjust for that, the valuations has pretty much remained around same level. And to give you a little bit more context, in terms of growth, SBI is doing better than HDFC Bank, and in terms of valuations, it is at a 50 to 60% discount. So that explains why there is so much more interest in an SBI and why HDFC Bank has been underperformer in this entire up move that we are seeing. So I think given the kind of positioning that State Bank has and the particularly in these quarterly numbers, the overall credit growth was about 21%. So that makes us far more confident about sustaining this kind of a growth. And as I said before, we are looking at 32% growth over the next 2 years from State Bank of India.
Coming in on SBI and some of the other peers within the entire PSU banking space. Meantime, another set of earnings then, Hemang, the street will react to is, you also had the BPCL numbers that did come out. What's the outlook given the fact that you have seen the net losses that have, narrowed down quite significantly? We've seen the GRMs, though, that are down nearly 39% on a year-on-year basis, but the one-time compensation from the government really seemed to have boosted the EBITDA as well as net profits. How would you read into the BPCL earnings?
So, we would not be very positive on this space for multiple reasons. One is that you're seeing incremental government intervention, when they are trying to infuse some money, there was extraordinary profit that was imposed. You see so much of volatility in the crude oil and the GRMs. And we don't know what sort of divestment plans the government has. So though these companies are looking quite strong in terms of fundamentals, but because of the moving parts around it and most importantly the government intervention, we think that it would be better to stay away from these names and focus on the companies where there is a better growth visibility without any government intervention.
Okay, oil and gas and without government intervention, we're all waiting for those days, aren't we, Hemang Jani? But to be fair, we are of course seeing more market-driven pricing than we used to earlier. Well, let's just return to banks. And Nikunj, we had Naresh earlier on the show saying, when he was talking about Bank Nifty, saying, yes, we might take the all-time high, but can it stay at those levels because HDFC Bank has still not started moving the way historically we are used to. I know you have very strong opinions on this one and how the elephant can start dancing.
My logic is very simple, that if there is growth and if there is market share gain and if there is a huge advantage in terms of where the customer base is going and the deposit base is going, and if your balance sheet is under control, it's a matter of time markets will recognize that. It's not for the first time we've seen stocks go into sideways movement. It is not for the first time when the near-term concerns sometimes far outweigh the real true potential of the franchise. We've seen that, let's say, happen in SBI. Nobody understood the true potential of the franchise, and today SBI is like the toast of the town. We've seen that happen to, let's say, the entire banking sector last year. We've seen that happen to individual stocks like Indian Hotels and ITC for a long time. So I'm just bringing out these names for the benefit of our viewers. How do you judge the banking sector, Nayantara? You look at the advances. For HDFC Bank, it's 20% plus, higher than the industry average on a balance sheet size, which is the second biggest in India and will now be the largest after SBI post the merger. Then you look at CASA. Are they getting CASA, which is cheap, low cost deposits? The answer to that is no. It's at about 9%, much bigger than a 9% market share only next to State Bank of India. Third, do they understand lending? The answer to that is yes. I personally feel the merger of HDFC and HDFC Bank was not a forced merger. It was a well thought merger. I know this is not the popular view, but once that entire merger goes through, then you are looking at a sizable balance sheet and a true franchise which has potential to gain more market share and more importantly create some kind of a large business in the real estate stroke the HFC market, and this is where I think markets are missing on it. So in the near term, which is FY23, FY24, of course there would be merger challenges and return ratios will be under pressure, but what happens after that? I think markets are focusing too much on FY23, a lot on FY24, but what happens after that I think is just getting completely lost in the foggy environment, so to speak. Hemang Jani, I can see you nodding your head. Now is that a yes or a no? Because I don't know which way you're nodding.
Yeah, Nikunj, so I think having seen a big underperformance in the last 2 years, I don't know whether it was purely because of merger or because of the slowdown that was there. But whatever it may be, I think if there is going to be a significant growth at the economy level, at the capex level, then obviously given the size and positioning, HDFC Bank cannot be ignored. And if you look at the performance, leave aside the valuations argument, even when things were so difficult, I think, the performance was never an issue. They delivered almost about 80-90% kind of a growth. This is one of the fewer banks with a very healthy CASA ratio and much better net interest margin. So I do not see bank Nifty or the banking stocks perform without any support come through from HDFC Bank from where we are right now. So we do sense that there is a tremendous risk to return for somebody who wants to invest, from a 1 to 2 years kind of perspective when it comes to HDFC Bank.
Some views on the charts as to how you're seeing some of these listed insurance players performing, because it has been a little bit of subdued volume in terms of the numbers. So what about the charts, SBI Life, HDFC Life? Where is it that you see the most potential?
So out of all the names, I would be watching out for something like a Star Health, which has been popping up on our charts. But the rest of the names, we are seeing very dodgy moves. So for example, SBI Life took a leadership move, went back, did a big gap up back in August, retraced the full gap, and now it's making a slow recovery. But it is still closer to a high all-time high zone rather than towards the lower end. Then you look at the rest of the names, we have a very unusual chart. ICICI Prudential remains sideways. HDFC Life continues to be at the lower end of the range for the last 6 to 8 months. So the problem is every stock in the sector has very different positioning as such in terms of the technical charts. So a lot of these names are like ICICI Lombard, HDFC Life, ICICI Pru are on the lower end of the range. SBI Life continues to be the leader. But the one I would be watching out for is Star Health, because that has been sideways for a long period of time and has been making a sideways consolidation for the last 4 months. So out here, once it crosses 750, that is the point of time I would be interested in Star Health. But that is the one which comes up on our technical radar, wherein it has been a tight range of 680 to say 750, 780 for the last 4 months.
All right, now guys, you got the strength in rupee. Kunal, 81.5. How much has rupee gained from the recent low? Can you just tell me? I think it was almost 82.6, almost 83.
Yeah, almost. So I think it was 83.
It touched 83.
Yeah, it crossed 83.25 or 26 was the low for rupee.
Okay, so 83.25 has become 81.4, which means this is almost a 1 rupee 80 paisa uptick.
Correct. Almost a 2.5%.
Now what happens technically?
And look at the falling dollar index from 115 to now we are talking of sub 110. So I think on Monday we were at 110.5. Today we are at 109.5 for dollar index, and the fall is getting a bit aggressive for dollar index. So this should just aid rupee for some more time. I think 80, 81 should be, or below 81 and just above 80 should be the near-term target now for rupee.
Aisha, there are two factors which we've flagged off for our viewers are concerns for the inflation. One is the strength in the dollar index that has reversed, and second is the strength in commodities. We are in for a cold winter, we are in for a tough winter, we are in for a harsh winter, we are in for a dark winter, we are in for a chilly winter, whichever terminology we want to use. That is the way how things are stacked up, at least for Europe and for US, because of lack of energy prices. But crude is nowhere close to $100. The point we were discussing on Monday, I think. It just tells you that there is a breakdown in demand. And when demand breaks down, commodity is unlikely to outperform. And if there is weakness in the dollar index, I think there is also a bit of a challenge there. Also, let's not lose sight of the fact that we've not spoken about it. There is counting in US, midterm polls. It is highly unlikely that Democrats will get both the Senate and the House, which means that the Aam Aadmi, if I may use the Hindi terminology to describe the average American voter, is feeling the pain of inflation. Politics does influence economics, and I think we could be headed there also in terms of what the US Democrats will now do in order to control inflation and bring interest rates down. The cost of repayment, the cost of filling your gas tank, everything has gone higher.
Yeah.
So demand starts coming down. If interest rates they start peaking out, then we are in for a very different kind of a scenario. But today, I think it's not the bank nifty all-time high. For me, what really matters is rupee. Hemang Jani, 81.15, 83.26 has become 81.14. That's almost a 1 rupee 80 paisa again.
Yeah, Nikunj, so I think this has come as a big positive surprise, and what our sense is that as you move into the next, let's say, 3 to 6 months, when you see incremental flows from the FIIs, both in equity and debt segments, as we do see, once there is a conviction on the earnings and the revival, you might see this play out extremely well for India. So overall, we think that this is a sign that we are in for some kind of a reversal in terms of flows, and that makes us believe that you will be able to deal with this intervening volatility much better when the domestic institutions and FIIs both would be on the buying side. So I think it bodes well for the markets.
Okay, so you've got the rupee zooming past 81 rupees and 50 paise against the greenback currency. Shospi pointed out cryptos crashing and how on the back of the US dollar strengthening, and the big Binance deal trying to back FTX falling below $17,000 briefly. Well, it's that time of the show where we get you all the stock-specific ideas as well from the broader markets. Kunal, I'll come to you first. When we talk about the broader universe, what's on your radar? What's the recommendation?
So I would suggest a bond IRB Infra. We discussed this stock on Monday as well. I recommended this. The stock looking very attractive. Multiple patterns getting breached for IRB Infra, inverted head and shoulder, a triangular pattern, a flat pattern, as well as a breakout of previous swing highs for the stock. So would suggest a buy with a target of 270, stop loss at 248.
And Naresh, what about you? What's made it to your list today morning?
So that would be a buy on United Spirits. The stock gave a breakout about the 880 to 900 mark and has been consolidating at the same price for the last 4 sessions, making a small flat formation on hourly charts. Once it sustains about 905, 910, you could see a quick move towards 1000 levels and towards a new all-time high as well. So out here, short-term trade as well as a little medium-term view, a stop loss at 870 and a target price of 1000.
Okay, on that note, Hemang, great to have you on the show as always. We'll let you go, counting down to the market open, and fingers crossed, hopefully we should hit an all-time high on the Nifty Bank today itself. But